In this video, I'm going to walk you through the 3 common mistakes people have when they come to selling short strangles. And if you can avoid these 3 mistakes, then you're guaranteed, in my view, to become a profitable trader. And I'm going to show you a trade based on my own trading criteria live in this video. So we've got IWM, which is the Russell 2000 ETF. And the first mistake that traders make is that they trade too large on individual stocks with high volatility. Now, again, you can make a lot of money by doing that, but the challenge with doing that is if the stock goes against you, if you don't know how to manage positions properly, then you can get into a lot of trouble. So that's why I like to stick with indexes, IWM, SPY, Qs, etc. IWM is the smallest of the 3 products, which again has the lowest margin maintenance. The second mistake that people make is trading on short expirations. And I get it. I used to be one of those traders where I used to sell weekly options. They decays really quickly. The challenge is if it goes against you, and I know you can roll down and out, up and out, and all these other different things, but the challenge is sometimes if the move is that aggressive and that large, it's very hard. And again, then your position turns into the wheel strategy. You'll get signed and start selling calls, all these other different things. I like to sell options 40 to 60 days out in the monthly expiration cycle. So I've got December 15th, which is 42 days out, which is the December monthly cycle. And again, the reason why I do that is that if the trade goes against me, I've still got enough time or enough intrinsic value to roll it out into the January cycle and put my strikes in a more favorable position. That's point 2. And the last point is strike selection. A lot of people like to put strikes really far out the money at a 5 delta. Some people like to put it really close to the money. There are pros and disadvantages for each one of those 2 things, but the optimal delta is between the 16 and 20 delta. So if I go on the put side, you can see the delta there. We've got 17.8 at 164. And if we go to the call side, looking here at the delta column, we've got exactly an 18 delta. It's 9 delta, 18.6 at 186. You can see here the mid price for around $240. I'm going to go order that. And if we just quickly look at the margin requirements for this position, you can see here that with an equity to loan that I currently have for about 16K in this account, I'm going to be using around 2K of margin to place this trade, which isn't bad in terms of an overall portfolio. I've only got one other PayPal position in there, which is not taking a lot of margin. So overall, I'm not looking to be in a bad position for this overall trade. So if we go back here to here, we've got the 238. I'm just going to try to get filled at 238, I think. If I slide to submit, order is pending, order is filled, right? So I've made $238 in this position. Now, the key to this is how do you manage this position? Now, I've got lots of videos on that, which will be on the screen, hopefully, or in the link inside the description. But effectively, I'm looking to make 50% on this position. Taking your profits early, the research shows that's how you become consistently profitable as time goes on. So again, if you like this video, got any value, please like, subscribe. And again, if you've got any questions, comment down below. And I shall see you guys in the next video.